Disclaimer: this video is for educational purposes only and is not financial advice. Always do your own research before investing.
In the span of just 1 month, 10 different funds companies dumped 17 new ETFs onto the Toronto Stock Exchange. Gold covered calls, bank stock covered calls, utility covered calls, and a structured note dressed up as an ETF paying 6.4% a year. If you feel like every issuer in this country suddenly discovered the word yield at the exact same time, you're not wrong. But here is the $1,000,000 questions. Are these new funds actually worth your money, or are they just repackaging the same covered call formula with a new ticker? I went through every single launch from July 2026, pulled the prospectus, and sorted the one that actually deserve a spot on your watch list from the ones that are just noise. Let's go get into it. Before we touch the new funds, you need the backdrop because it explains exactly why issuers are launching income products all at once. July was messy month for market. The S&P 500 basically closed flat, dragged down by a Middle East oil supply shock and a retreat from AI names. On top of that, both the banks of Canada and the US Federal Reserve held rates steady, so there was no fresh rate cut tailwind. And yet, Canadian ETF investor poured in $18.2 billion in July alone, pushing year-to-date inflows past $122 billion. Equity fund made up two-thirds of that. That combination, flat market, steady rate, but strong inflow, is exactly the environment where covered call and enhanced yield products get marketed hardest, because issuers know investors are hungry for cash flow when price returns stalls out. Quick gut check before the new launches. The best performing Canadian ETF in July wasn't an income fund at all. It was the Long Point Mega Short 3X US Semiconductor Daily Leverage Alternatives ETFs. Ticker SOXT, up nearly 65%. That's not investing, that's the trade. I'm not covering it further because it has nothing to do with what we are building here. More relevant to this channel, Harvest enhanced high-income single stock funds on Microsoft and Suncor put up returns in the 25 to 29% range, and Evolve's Ether ETF gained almost 23%. Worth knowing, not worth chasing off one good month. Now the new stuff. The issuer you already know, Harvest, Evolve, and Brompton, accounted for 6 of the 17 launches. Let's break them down provider by provider. Harvest added 2 funds. The Harvest Premium Yield Gold ETF, ticker HPYG, give you exposure to physical gold bullion alongside gold mining equities, with an active option strategy utilizing covered calls and puts plus moderate leverage to generate high monthly income. There is second fund, HHII, is the Harvest International High Income Shares ETF. This holds developed market international equities with an active covered call overlay. It comes with 0.65% fee. This one fills a real gap, since most Canadian covered call shares are overloaded with US and Canadian names and thin on international exposure. Evolve launched 2 sector-specific yield funds, CFIN or CFIN, the Evolve Canadian Financial Yield Fund, and CUTE, the Evolve Canadian Utilities Yield Fund. CFIN is an equal-weighted basket of the top 10 largest Canadian banks and insurer with covered call and 0.60% fee. Honestly, CFIN is redundant if you already hold a broad financial covered call funds. You are just reslicing the same names. CUTE is much more interesting. It tracks the Selective Canada Utility Index, holding an equal-weighted basket of utilities, pipelines, and telecom like Fortis and Enbridge, yielding over 14%. Utilities pair naturally with covered call because they are low volatility, making this a great addition to the space. Brompton rounded out this group with PAYE, the Utilities and Infrastructure High Pay ETF, and PAYU, the US Equity High Pay ETF. Both are actively managed and pay distribution twice a month or semi-monthly. Pay 16 cents per share semi-monthly, yielding over 16%, and PAYU pays 20 cents per share semi-monthly, yielding a massive 18.8%. To achieve this, both funds use a target leverage of approximately 25% plus active covered calls. Leverage is a double-edged sword that amplifies losses as well as income. But Brompton has over 25 years of experience and has paid out over billions of dollars since inception. If you are comfortable with leverage risk, these are high-quality bi-weekly income tools. 6 funds, let's score them. HPYG Gold plus minus moderate leverage, a trade of HHII International Developed Covered Call fills a gap. CFIN, Canada Bank and Insurer redundant. CUTE, Canadian Utility yielding 14%, a standout. PAYE and PAYU, Brompton High Yield pairs 16 and 18.8%. 5 of 6 are legitimate tools. CFIN is the skip. Now here's the part of the story that got buried under all the yield headlines, but it might actually matter more long term. Capital Group, a massive US active manager with $2.2 trillion in assets, just listed 3 active ETFs on the TSX. CAPU for US equities, CAPQ for global dwarf equities, and CAPN for international dwarf equities. These aren't income funds, they are straight active equity strategies. The fact that a firm of this size is building a full Canadian active lineup tells you where the industry is heading. Big US managers are moving north because Canadian investors prefer the ETF wrapper over mutual funds. At the same time, Madison Investment entered the Canadian market with the two active funds, MLRG for US large cap and MMID for US mid caps. They focus on high quality, stable business franchises. Neither of these yield play, and active managers live and die by track records, which none of these have a Canadian sol yet. Put them on a watch list and monitor them before buying. Now let's look at the single most unique launch of the month, which doesn't fit any of the traditional boxes. Purpose Investment listed the ETF series of the Purpose Structured Equity Yield Funds trading under ticker PSY with a targeted annual distribution of approximately 6.4% paid monthly. This is not a covered call, it is an active managed derivative strategy built to generate income with contingent downside protection. How does this actually work in plain English? The fund holds derivatives linked to major equity indexes. It sets a barrier level, typically 30 to 40% below the starting price. If the stock market drops but stays above that barrier, your principal is protected and you collect your 6.4% monthly yield. But there's a catch. The protection is contingent. If the market crashes through the barrier, the protection completely vanishes and your investment takes a full hit of the market decline. You also give up all the market upside. If the market rocket higher, you only participate in the 6.4% yield. While the ETF series is new, Purpose has run this strategy as a mutual fund since 2019, growing to over $2 billion in assets. If you want stable income and willing to cap your upside for moderate protection, PSY is a well-engineered option. Just read the fine print before investing. Let's quickly run through the remaining 5 launches for completeness. Though none of these change your core portfolio strategy, first is BMOZCDX, the Credit Stress Opportunity ETF. This is a tactical, actively managed credit fund for professional bond traders, not retail dividend investors. Second is Guardian's GIAI, the i3 AI Technology and Innovation Fund, an active technology fund in a very crowded space. Third is a Lysander Canso's PBY, the Creditor Income Active ETF managed by Canso Legend in the Canadian bond space. If you want active corporate bond exposure, this is worth a look. Fourth is a IA Clarington IIME, an international multi-factor equity fund using quantitative factor model to pick international stocks. And fifth is NBI's NSDC, the Smart Data Canadian Equity Fund, using quantitative data to select Canadian stocks. Interesting, but none of these changes how we build an income portfolio today. So what is the ultimate takeaway from the 17 ETF launches of July 2026? Out of 17 funds, we have 5 solid gap-filling income products with excellent institutional pedigree, 4 active US and global funds testing Canadian waters, 1 structured yield play in PSY that's worth a look if you understand the barriers, and the rest are highly specific tactical plays you can safely ignore. The bigger lesson in this, when market go flat and interest rate hold steady, issuer respond by launching way to manufacture yield. Some of these like Brompton's high pay funds or Evolve's Qt are genuinely great tools, but many are just high fee repackaged version of what you already own. Know the difference before you add anything new. If you want me to do a full deep dive video on Purpose PSY, Brompton's high pay leverage strategy, or the new Capital Group active lineup, let me know in the comments below. Hit the subscribe button so you don't miss our next portfolio update, and I will see you in the next video.